as I speak. I'm more than happy to go through all of that, but we will make a start on. Look back to last week. I'll share my screen. Obviously, the big event of last week was the payrolls and the unemployment data that came out on Friday. Before that, we had manufacturing PMIs, JOLTS, and ISM services PMI. Manufacturing missed slightly, but as we see later, manufacturing is not really a large component of the US economy anymore. I'll get a chart on that later. So that's been missing for a while, actually. It's been coming in cool for a while, and indeed, I suppose manufacturing in the US has been contracting for a long time. More job openings than expected. ISM services missed a little bit. That was a bit of a surprise. Actually, services came in above. Actually, they didn't miss. Well, they missed, but they missed in a positive sense. The services sector expanded more than expected at 54.9 versus the consensus all in the low 50s. So that's a positive piece of macro data in terms of pointing towards a healthy economy, healthy services sector. Non-farm payrolls was really the big thing of the week, though, coming in at a stonking 250,000 versus an expected 140. So you do get these sort of big surprising numbers in payrolls from now and again, and oftentimes they're revised at the next meeting. But we did get a revision here for the previous. It was revised up from 140 to 159. So that, coupled with the fact that the unemployment rate dropped to 4.1 when it was expected to stay the same, was pretty significant for interest rate expectations, for economic expectations, and really had some quite big impacts. Less so in the equity market, actually. I suppose the impact on the equity market was relatively muted, as we can see here. This is the chart of S&P, Russell, and gold. When the data came out, every equity spiked, gold fell, and then within a matter of hours, everything had reverted back to where it was, which is often the case with non-farm payroll announcements. In fact, equities, the S&P actually finished a little bit lower. Since then, it's been more of a broad downtrend in the Russell, as one might expect, because we saw quite a bit of interest rate cuts priced out, also in the S&P. But we're up after the after the news on, I suppose, positivity about US economy, soft landing seemingly more and more likely, but perhaps an element of disappointment from markets that November now looks like 25 basis points nailed on, and there's even a small probability of nothing in November. So that may well be weighing on markets. Just at the moment, it's a bit of a push-pull between glass half full and glass half empty, in the sense of the economy looks like it's on a very strong footing, but that also means that the Fed are likely to do less. Albeit we did have quite a bunch of headlines this morning from one of the Fed members trying to push back on that. In other areas, VIX marched higher on Monday. No real catalyst that I can see. There's a lot of volatility in Chinese equities. The Middle East situation continues to progress in a pretty violent manner. Not sure if that's pushing VIX higher, or we're just getting closer to US elections, but interesting to see both the VIX index and the VIX futures, at least the October contract. This is the November contract. It's down at 20, but October is up at 22. And this red line is the volatility of VIX options. So like the implied volatility for VIX options, and that's up at 122, whereas just a while ago, it was just at the start of October, we were all the way down here at 91. So VIX option volatility is indicating demand for VIX options, and VIX itself is going up. So there's definitely a bit of buying of volatility going on out there. You might have noticed S&P implied vol. If you're looking at things like bull put spreads, is, as we can see, it's November the 15th vol up at 20. A couple of weeks ago, that would have been down at 14. And we can touch on that a bit later. That may offer some opportunities. I didn't share that screen, but never mind. But we'll look at S&P volatility a little bit later. This is gold. Keeping an eye on gold for a while, I suppose. Last week, just pointing out that around about here didn't look like the best time to buy, just given the distance away from the 20-day moving average. So it was overbought on that measure. It was overbought on RSI. That overbought condition is resolving, mainly through gold going sideways, but I suppose it is a little bit lower over the past, I don't remember what the range of this chart is, but over the past few candles, you can see gold ticking lower. I think it's probably an hourly chart. I imagine if we didn't have the escalation in the Middle East, gold would probably be a lot lower. But I think that is keeping a bit of a bid there, despite the fact that interest rate expectations have shifted significantly. This is interest rates with the 2-year rate on the candles and the 10-year rate on the solid line. So we've seen that, as we've looked at before, this 10-year trading over the 2-year is normal. This is more what we call inverted. So that's a curve sloping like this, where this is the 2-year, this is the 10-year. It's not as extreme as that, of course. Normally you have an upward sloping curve. It's just got a bit back to flat, and that's because of the big repricing in the front end in interest rate markets, and that's a little bit of a change there. In currency markets, one of the biggest, we've seen, said the impact of payrolls was not really felt all that much in equities. A brief rally, and then things are back to where they were. But we certainly are seeing VIX higher, gold muted, interest rates higher, and the dollar quite significantly higher, plus 5% versus the yen. See this big that blue line is the payrolls data coming through. So we've been on an upward trend before that, as some of the other macro data was looking more optimistic, but that payrolls number really did punch the dollar higher, particularly against the yen and some other crosses. The dollar stronger. Oil been having a bit of a rip over the last few days. That's come back slightly, but broad commodity markets, which is the blue line, sort of industrial commodities. I was wondering what my cat is doing. Sure. Broad commodity markets moving higher, perhaps on the expectation that the stimulus from China will lead to a pickup in consumer demand, pickup in demand for commodities. That, of course, remains to be seen. And we'll look at a little chart a little bit later on China as well. But oil spiked higher, but coming off. What's that? It's about 3% off the highs on oil. This is the interest rate expectations tool that we look at, and really a really dramatic shift here. Normally we've been looking at this, and this bar on the right is a 25 pip cut, and this one on the left is a 50 pip cut. But actually, what's happened if you look down here, where it's got the week before and the day before and today, this 425, 450, that's 50 basis point cut. That's 25 basis point cut, and that's a 0. And we've actually shifted from having almost 40% probability of 50 basis points prior to payrolls to exactly 0 today, and actually 12% probability of actually them doing nothing not cutting rates at all, which would be quite a shock, quite a turnaround from what we were thinking post the 18th of September. It just shows you how quickly these things can change. We've still got plenty of time before the next Fed meeting. It's not till the 7th of November, so expect a lot of headlines like this in the meantime. This suggests, this is Adriana Kugler at the ECB conference, just a bunch of headlines that popped up this morning. Very much giving a very dovish message, support shifting attention to maximum employment, fully supported 50 basis point cut. Remember, we've got FOMC minutes tomorrow night. So maybe that's the start of Fed speak pushing back on the probability of zero cuts being introduced. If you go on Trading Vision or some of the news websites, you'll see many more quotes from her, but they're all of the same sort of tone around trying to be accommodative and being prepared to act if the labour market weakens. So that sounds a bit like the Fed are looking at the market reaction to Friday and saying, hold on a minute, we're still going to cut rates in November. Things are not done and dusted just yet, but we'll wait and see more of those headlines and more Fed speakers, no doubt, over the next few weeks. I thought this was an interesting chart that I discovered on the web. We've been looking at this is a manufacturing PMI, has been missing for quite a while. It's been weak for quite a while. Below PMIs below 50 are said to be in contraction mode. But the question is, as always with data, does it really matter? And the perception is the manufacturing PMI is a bit of a bellwether for recession or not in the economy. And I've got another chart. I didn't put it in here. It's a bit complicated chart, but it just sort of regresses the PMI versus GDP, and it shows that pre-COVID there was sort of a linear relationship between them, but actually post-COVID there isn't. There's no relationship. Bizarrely, I don't know if that's just an artifact of the data, but it's certainly clear that as a component of the U.S. economy, the manufacturing sector with 13 million jobs is not really as significant as the services sector these days. Was different back in the 80s, but manufacturing has been declining, and of course services have been booming, as is the case across the developed world, I suppose, but particularly in the US. The other bit of, I guess, the other topic at the moment is just what's happening in Chinese equities. We've been kind of keeping an eye on that for the last few weeks. But this was an interesting chart. I think I've mentioned 2015 as well. That was the last sort of big bubble in the Chinese equity markets, and see this headline that there's an influx of young investors, overwhelming trading platforms, and this we saw exactly the same thing back in 2015, a massive jump in opening of brokerage contracts, which was refueling the bubble, if you like, that sort of positive feedback loop. But eventually that equity bubble in 2015 burst quite spectacularly. And we've got a little bit of another chart a little bit later just to show that the Chinese equity markets are a bit different, not really the same as US, European equity markets. They trade a little bit differently. But this is just another chart that shows us really, really strong demand for buying upsides on Chinese equities. FXI, if you didn't know about it, FXI is a Chinese stock ETF. So that is a way to go long, or rather perhaps go short. Maybe a bit brave to go short here, but I think probably it would be the right trade sooner rather than later on Chinese equities. FXI might be something to look at. But yeah, very expensive calls there at the moment. Almost as expensive as COVID. 2008 is not on this chart because if we put 2008 on that chart, it would look like this. This little spike here was nothing compared to what happened in '08. So that's why we don't have '08 on the chart. This sort of 25 delta calls got a bit crazy then. We look at 25 delta call vol because 25 delta is sort of where you have maximum leverage on the calls, where you're really getting that sort of more Z, J curve type thing. So people are looking to get max bang for the buck, I suppose, on leverage versus not being too far away. They tend to look at 25 delta calls, so it's a nice bellwether for supply demand in that space. So I thought this was interesting. This is the Chinese equity market, the Shanghai 50. We could put the various different on, but they all kind of look the same. For the last 13 years, it's done virtually nothing. It goes sideways, it spikes, it comes off, it spikes, it comes off, it goes sideways, it spikes, it comes off. This was a particularly long sell-off as China struggled with restarting their economy post-COVID, and maybe didn't do enough stimulus when others were doing stimulus, but really the impact of COVID was felt, or at least the Chinese equity market just couldn't catch a bid post-COVID, so it sold off. And then we finally get the stimulus everyone's been waiting for, and it spikes again. Now, a normal equity market, normal equity markets look a bit like, well, we don't have one on there, but I think you'll know what normally they tend to go up over time, and they maybe come down at times, but they do tend to go up over this period. You know, S&P, you probably don't need to see the chart. S&P just looks like that really, with some sell-offs along the way. So the Chinese equity market almost trades a bit more like a meme stock, like GameStop. It spikes, it comes off, it spikes, it comes off, or a meme coin like WK41. So it's a different beast. It's not really, I wouldn't say it's a buy and hold. It's something to, yeah, if there's a bubble, it can keep going. Like we saw back in 2015, very similar run up, but then it burst very quickly. So I think if you have been participating in Chinese equity markets, hopefully you took profits before today. I'm not sure today is the bubble bursting. That will be a bit soon, but certainly Chinese equity markets are cooling off after reopening. We've had a holiday in China on the onshore markets since the 30th of September. They just reopened. While they were closed, the Hong Kong markets went higher, but actually post China reopening, Hong Kong has collapsed back to below where the CSI 300 opened. So you can see on that chart, Hong Kong today is off about 11%, the HSI. A big collapse there, as perhaps people are disappointed. I mean, there was a press conference announced this morning in China that was unusual, and people were hoping that maybe that would be another. There would be more news there, more stimulus and more things happening, but there was nothing. And that, coupled with, I guess, profit taking on the onshore market reopening, has cracked HSI significantly lower. Almost 1/3 of that rally gone this morning. So yeah, just a reminder that Chinese stocks are a bit more boom and bust, and trade a little bit more like almost like VIX or GameStop than a normal equity market. So they're certainly not a long-term buy and hold. I think they're made for trading. Depth spreads, as we talked about before, work quite nicely. This sort of thing would not be pleasant on a bull put spread. I definitely would have gapped through stop losses there. What's coming up this week? The main thing this week is the We've got another Fed speaker. We had Fed speaker yesterday. We've got really, it's Thursday inflation data, and it's tomorrow with the FOMC minutes. So market will be, I mean, in some respects, the minutes are maybe a little bit out of date post the payrolls data. So the minutes will likely be quite dovish, based on the tone of Kugler and Kashkari yesterday. But that's a little bit of out of date, given that we've just seen a bumper payrolls number. So market reaction might be a bit muted to the minutes, but certainly any concerns over the labor market might be relevant. But yeah, U.S. CPI initial claims, that's the big thing this week. Um, the biggest risk for markets at the moment, I think, is not so much recession. I mean, that's always a risk, but it seems like it's been pushed out a little bit. The data all seems very strong. I think the risk would be that we start to see inflation tick higher. Um, this chart just shows you sometimes Chinese equity markets go up, and sometimes commodities also go up, and commodities higher generates inflation. So there's some people probably looking at the spike and the stimulus that's coming out of China and suggesting that might drive inflation. But sometimes it does, sometimes it doesn't. You see the equity bubble, the last bubble that we had in 2015, which was based off similar stimulus, just didn't impact commodity markets at all. So we wait and see. The stimulus, all this, what we've had announced from China is just a broad framework. There's still not a great deal of detail, and as ever, the devil is in the detail. But the markets reacted first, given their more volatile nature in China, shall we say. The markets reacted very quickly, but if we could see a bit of disappointment setting in if what's actually delivered is not as significant as what people think is coming, and that's certainly driving price action this morning. That's just some more quotes from Kugler, again being very dovish, saying it's resilient, but we want to still avoid an undesirable slowdown in growth. So those headlines just kind of reiterate, I think, the Fed seems to be pushing back on the knee-jerk reaction, if you like, to payrolls. So we'll wait and see how that develops. So it's set up to be a week where the focus is really going to be on inflation, but maybe the minutes as well tomorrow. So I think the big risk for equity markets, absent the data deteriorating rapidly, is that we see those inflation numbers tick higher, oil ticking higher, commodities ticking higher. That puts the Fed in a difficult position because they want to cut rates to meet their full employment mandates of the labor market and keep the labor market ticking over. But they also have they have an inflation target, they have an inflation focus. If inflation looks like it's going higher, they'll probably prioritize inflation over the labor market. That tends to be what they do, and that could be quite tricky. That counterintuitively, a pickup in inflation might lead down the line to recession if the Fed have to stop hiking interest rates, or even stop cutting interest rates rather, or even start pricing in hikes. That would be the next thing that might happen if you saw that CPI come in hot. Probably not going to be an issue this week. The stuff happening in China, the interest rate cut that we saw in September probably hasn't had long enough to permeate through to the economy. But any upside surprises in inflation likely to be quite negative for equities at this point in time. All right, well that's what's been happening, and that's what's likely to happen. So that's what's coming up, at least in the data. We are just about. I don't have the chart; it's in one of the other packs, but we are just about running into the end of that sort of seasonally bearish period. So we managed to get through this week, okay, and Fed speak soothes the market a little bit on interest rate expectations. We may still be on course for a year-end rally, but it's just a little bit more. It's a little bit more balanced now than it has been perhaps prior to that payrolls number just upsetting the apple cart, so to speak. So I'll stop there. I'll go back to sharing the web. Is it time to sell Chinese ETFs? Depends what ETF you're in, but certainly probably right now is not the best time because they're selling off quite heavily.